So let's chat with our friend Todd Halterman today. Good morning, sir.
Morning.
So, we've chatted about this in the past, and I'm getting more and more calls on this, Todd, where people are worried, as much about, investing is a dime a dozen, right? You can go on, what is that, Robinhood, and is that investing or is that gambling? I think that's probably just as it's probably more risky than gambling because at least you know the odds when you go to the crap table. But I digress. But one of the things I'm hearing more, so there's all kinds of places to go and throw your money out as an investment. But once you get to a certain point, you're really more concerned or equally as concerned about risk management. Are you coming across that at all?
Well, everybody's a little puzzled about this run in January of being 8 to 10% up on the indexes. I think it's giving some Americans a little false confidence on our forward-looking opportunities. It seems like economists are really advocating for a lighter recession than we expected, earlier or last year. So things are cautiously optimistic, but there is going to be some kind of deceleration of the velocity of cash. And we're going to go through a short period of what I would call stagflation, where things are just level. Corporate earnings are waiting to come back. Supply chains will catch up. But never have I seen a major recession where there were help wanted signs everywhere, Ron. So there's a lot of confusion in the economy.
Yeah, and it doesn't help having the confusion coming out of with government numbers. I mean, I went over on Monday when we did a deep dive over the weekend looking at the jobs report, and the BLS jobs report raw data showed 2.5 million jobs lost, yet we report 517,000 jobs gained. The household survey showed 81,000 jobs gained because they had 810,000 they added because of a population control adjustment. So you got all those numbers coming in there, and then you look at the ADP report, which I say is the only one that's accurate because it's got 25 million records of real people, and they say 106,000 jobs gained. All these different numbers, and how could people not be confused?
Yeah, and when you see the market swelling up like this, it's based on current news, current information. Corporate earnings are coming in mixed. Some, like Disney, are getting a real big jump in their value right now because they're turning their earnings around and they brought in Iger. But there are still some real risks out there in the marketplace, and we expect more volatility. And because the market's bounced back to what it looked like it was about this time last year, this is a time where people should rebalance and prepare for the next chapter. And that's really what we're spending a lot of time on right now, is trying to help clients assess their risk properly and adjust things while we're at what I'll call a neutral position, and be able to help them with the forward-looking environment.
So the question I would have, because I'm not in this world, I follow it a little bit, but no, I'm not from a different planet. Some people might say that, but I'm not watching all the financials, but the vast majority of the companies that are getting a boost in their stock price in this earnings season, the consistency that I see is, even like Disney. Disney's stock price went up right after they announced that they're going to lay off 7,000 people. Right? Zoom says they're going to lay off 1,300 people. Amazon's laying off. Microsoft's laying off. All these companies are laying off, so their stock prices go up. Is that the catalyst for raising your stock prices, is laying off labor?
No, I think that's an adjustment to the net profit because the liabilities are going out the door. But the reality is it's really about action. What is leadership doing to drive distribution, grow their revenues, increase their bottom line by lowering expenses? And using Disney as an example, Iger has a long history of helping Disney get back to the brand that they've always been. And their media division took a real hit last year while they were getting their parks opened up and at full run as well. We see Disney as an opportunity. They are the leader in that industry, and they dominate. but they are having some systemic problems. And in order to improve the bottom line for the stockholders, cutting out some of that labor is a very effective way to begin trying to right the ship.
And Iger's got a great history of doing the right thing. So, unfortunately, Iger made the same. My opinion here is he made the same massive mistake that Jack Welch did at GE. They're great at running the company. They don't seem to be quite as good at finding their successor. So that's
Exactly.
just my thought right there. But so you've got this run up, Todd, where the markets, and some people will refer to that they maybe as, I think they call it, a dead cat bounce, right? The market's in a downward trajectory, but you get a great month or an exceptional month in January. How do we protect those assets? How do we mitigate some of that risk? Is it simple as what you said, rebalancing, or is there more to it?
Well, there's more to it. Obviously, it depends on how somebody wants to invest, what their time horizon is. So none of this is recommendations. It's just general information that we share so people understand they don't have to just hang on and wait for things to come back. Right now, we're really encouraging people who have portfolios in the index to start considering owning individual companies. In our firm, we go buy profitable businesses with huge economic moats, and they lead their industry or sector. Other investors these days are buying S&P 500 index, MSCI, NASDAQ, and they're writing the indexes. And the indexes really, they've got a lot of excess risk in them due to the volatility. So we believe it's smart to go out and find those cyclical companies with huge distribution that lead their industry, that have huge cash piles. They've got sustainable profits, and they really have a systemic advantage over their competitors. So we're looking for big companies with big profits, and there are many of them like Microsoft and Amazon and even Google that are down 18, 20, 30% right now off their high, and they dominate those industries. So we're helping people reposition into assets that will weather storms. And if people are in the indexes, we've got a solution we'll talk about in the next section and how to still stay in those indexes, but protect your principal if this market does go down in February like it did in August after the July run.
So, Todd did mention something there that I should have when I introduced him, but I do want to make sure that it is clear that Todd and I chat all the time, online and offline. Todd is a great, great educator. He is a financial planner. He is not giving financial advice this morning. He's educating us. If you would like financial advice, he does that many, many mornings. In fact, probably almost all of them. But you got to call him to do that directly because everyone's situation is different. And they have to go, when you're a financial planner, they've got something called KYC, I think is the acronym. And before you can actually give out advice, the regulators say that he has to know your client. So it's something that is, we want to make sure we honor that with Todd, and we appreciate him coming on and sharing with us. Continuing our conversation, Todd Halterman is on the line with us this morning in studio. He is a financial advisor extraordinaire. He is an asset protection specialist extraordinaire. Not giving financial advice this morning. We should just call him Professor Todd. So he's out here educating today. Professor Todd is with us. So, Todd, we were talking before about, you were talking, when you go and invest in an index, my take on this, and you'll have to correct me, is when you're investing in an index, number one, it's cheap. You get what you pay for. Number two, it's easy. And, if you invest in an S&P 500 index, it's going to be there forever. They're going to take stocks, they're going to put companies in, they're going to put them out. But, they're cheap and easy. You're not going to maximize your returns by going cheap and easy. That's my perception. Am I right?
Well, it's like anything else in the index. It's all about when you want to take your money out, and you're using time as your risk mitigator. and economic cycles, true economic cycles, swing in 15 to 17-year runs. Secular cycles are somewhere between that 6 and 9 year. So indexes are for people who really want to wait a long time to use their money and are trying to keep expenses low and keep their asset allocations simple. The challenge we find is that there's so much compression in the market with manipulation that we've seen the last 15 years with many different fiscal policies, that the index volatility has really never been higher. And every 10 years, we're having 100-year events. So those that want to invest in the index, really 6 to 12 big companies in that index drive the index pressure. And we subscribe to a philosophy: if you want to be an index investor, let me teach you how to mitigate some of that volatility risk so you can get better growth rates and you don't go down as much or at all with the index when it corrects. So those of you with an index investment, you should be listening to this, because I'm about to teach you how, for no fee or less than 1.25%, you can have liquid options to protect your investments in the market against loss. And so index investors do have options, and they can still get it no fee to low fee. But you know what? The general public's not real educated on some of these trusts that exist to give people that opportunity.
It's amazing that, this just baffles me, Todd, because, I'm working with a very, very high net worth individual right now. And, he wanted to buy a piece of property. So he went and we did a private money loan for him at like 9% interest. It's quick, it's easy, you get it done in a week. I don't know, maybe it's 10% now. I don't know the exact numbers. I look at the most sophisticated investors in the stock market, and the last time I did any research, the most sophisticated people will go into hedge funds, and they're paying 3% management fee and 20% of the profits. 20% of the profits. And they're happy to do it because they realize that, you're getting what you pay for. They're all they care about. They don't care about how much they pay. They don't want to be foolish and overpay, but what they are wanting to do is they care more about what's the return net than what am I spending? Right. So on that index, what can you just give me a hypothetical on an index? And I don't want exacts.
I'll give you an example. My own money. In June, I thought the market was going to be looking to bottom out or be close. So I set up an S&P 500 trust index fund where I put it into the market in June. And you know what? The market wasn't at a bottom. But what I set up for myself was, if the market went down 10% or less in 1 year, so from June to June, then if the market's down 10, if the S&P 500 index is down 10%, my principal is replaced and they add 10% to my total. So my neighbor in the index fund is at 90,000 and I will be at 110,000. So come June, my anniversary date of this trust, we look to see how the S&P 500 did over the last 12 months. And if it's down 10% or less, I will get that return in a positive interest rate. If the market is up, then until the market goes up more than 21%, I get 100% of the growth. So minus 10 to plus 21 is what I got when I deposited my money in that index trust. And so I'm going to make a positive return at minus 10 to plus 21.
Pretty significant. Those are great numbers where you don't have to worry about the challenges of that going down. When we come back, I want to chat with you though. So right there, we're looking at minus 10 to plus 21. When we come back, what I want to look at is, if we just went into the S&P 500, like what was the last 6 months of the S&P 500? I'll see if I can find that number while we're at break. Continuing our conversation this morning, Todd Halterman is with us, educating us. Professor Todd, we'll call him today, because His day job, he is a financial advisor, but we're not getting financial advice from him. We are just getting education. So if you're listening to us in the last segment, I was chatting about the idea. Todd and I were talking about being cheap and get what you pay for. So I just looked, Todd, at the S&P 500 index 1 year, going back 1 year, and it's down about 1/4% from 1 year ago. And just off the top of your head, I don't want it exact, but can you give me an idea of what the expenses are on a just a basic old S&P 500 index fund?
About 17 basis points on the Vanguard index portfolio.
Okay, so you're paying, so that's fancy for saying less than 1/4%.
Yes.
Right. So just want to make it simple. I'm a simple guy. So you're going to pay a less than 1/4% on an index that's down 1/4%. So you're off 0.5% for the year by going with an index down 0.5%. So think about that concept of what Todd was talking about in the last segment. Had you called Todd to set up something similar to what he set up for himself, you could potentially be up. You know, we don't know what the next 6 months are going to be because it's a 1 year hold. Well, this is going back 1 year. So Todd, just go based on this. If we look back a year, so this is up, this is down about 0.5% based on the index and the fees. You lost about 0.5% on your index fund. How would that work if we had set that up on the program that you're talking about?
Well, there on most of the chassis that we use, there's no fee or a very low fee. But in that instance, if today was the anniversary date, then that client would get their principal returned, and then that 1/4% interest as a positive deposit. But more importantly, their neighbor is down 1/4%. They're up 1/4%, which is a 0.5% difference. But I'll tell you, if it's down 4 and you're up 4, your neighbor's at 96,000, you're at 104,000, waiting for the bounce back. So, you know, if your neighbor's down 15% from 100,000 and you've got a 10% buffer against losses, your neighbor's at 85,000 in their S&P index fund, and you, my friend, are at 95,000 waiting for the bounce back because 10% of that loss is covered by the trust.
See, that's good stuff right there. Now, you made another comment in the last segment, Todd, I want to dig into because this is one that's not widely known. And you made the comment that, you know, there's a handful of stocks are driving the entire index. And I know that I think I heard one time last year that if you took the big 5 tech companies, that was like 40% of the gain in the NASDAQ. And if you took all the rest of them in the NASDAQ, which is what, another 4,000 companies, you know, you're probably losing money. And Jack Welch built General Electric by doing exactly what you said, right? He wanted to, when he went out and bought a company while he was considered it by many the greatest CEO ever, he went out and he said, I only want to buy company. Read it in his book. It's not me guessing. It's in his book that he only wanted to own companies that were number 1 or number 2 in their industry. And if they ever dropped out of that, he wanted to sell them.
Yes.
Kind of what you just said.
We don't buy stock. We buy profitable businesses with competitive advantages and huge economic moats. So
explain that. What is an economic moat?
An economic moat means they've got about 5 years of operating cash in reserve to run their company through any recessive cycle. They've got a history of profits that are going up at least more than 10 years. They have a distinct competitive advantage against their competitors in their industry in distribution, research and development, and of course, what I'll call profit. So an economic moat helps that company sustain itself through positive and negative events in the world. And we look for individual companies that can give our clients protection because a profitable business stock price might be broken. And I'll use Google as an example, but the company is not broken. And if anybody closes their eyes over the next 10 years and imagines what artificial intelligence, robotics, and technology will look like 10 years from now, Google is going to be at the center of all of that. This is a great time to own a company who's profitable and who's growing, and they own the internet.
It's just amazing. And again, that's not any kind of an advice for you to go buy Google today, unless you want to call Todd and find out if that's what's right in your situation. But it's for education.
It's an example of what I'm talking about with an economic moat.
Yeah.
And the reality is there are many stocks up over 20% in the last 12 months. So we find there's an advantage to being a sniper and going out and building assets for folks with companies that we love, because those balance sheets of those companies are way stronger than our government and stronger than the index.
Yeah, so they don't have a $31 trillion deficit.
Yeah, and they actually operate in the profit. So yeah, we look to give people selection and individualism and protection. And if they love their index investments, we absolutely use the index, and we do have index portfolios, but we put risk management around it because it doesn't cost any excess cost.
Yeah, you look at a company like Google, and I've just got it on my screen right now, that it looks like it closed a year ago at 138, and today it's at 94, 93. So the question becomes, is the company, what is that? Probably about a 40% drop, something like that. Does anybody really believe that was it wrong then, or is it wrong now? Because the company is not that much less valuable at this point.
The stock price is broken right now due to many factors, and I won't go into those details, but that company is not broken. And so we try to help people at this time rebalance and look for opportunities to buy things on sale that we believe have high conviction of opportunity in the next 3 to 5 years. And you don't chase returns, you buy profitable companies. And our index investors who have been down in the last year are getting their principal back, or they're getting positive returns because of our dual direction program. And our clients aren't coming in with losses or resentment. They're coming in with opportunity.
And I like the way you put that, Todd, that, company like Google, just think about that. You would, if you had a favorite pair of shoes or handbag or sport coat or glasses, sunglasses, say you wanted a pair of Oakley sunglasses and they're, I don't know, $100 a pair. I have no clue how much they are, but you could probably go and buy them for 60. Right? Same concept as Google right now. It was 140. Now it's at 97 or whatever. It's on sale, but you have to know which are the right ones, because not just because it's cheaper. I wouldn't be buying Bitcoin, even though it's 2/3 off of its high. Right. So I would not be doing something like that. That's just my opinion. You got to have a great financial advisor. Todd Halterman is that financial advisor, asset protection guru. I know that he also gets involved in helping people through his associations and relations with stock and financial planning and tax planning and all those good things, succession planning. So if you want more information, want to meet Todd, give me a call at 800-306-1990.